Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Equity Valuations. The section goal is to understand the valuation of equity and bond portfolio management, and the module goal is to apply equity valuation and its measurement. Valuation is a quantitative process of determining the fair value of an asset or a firm. In general, a company can be valued on its own on an absolute basis or else on a relative basis compared on other similar companies or assets. In valuations, we do fundamental analysis. The analysts use information concerning the current and prospective profitability of a company to assess its fair market value. Some alternative measures of a company value that can be used, such as dividend discount model, PE ratios, and free cash flow models. There are typically two approaches to valuations. First, discounted cash flow valuations relates the value of an asset to the present value of expected future cash flows on that asset. Discounted cash flow attempts to determine the value of an investment today based on projections of how much money that investment will generate in the future. The dividend discount model and the free cash flow model are the examples. Let's discuss the dividend discount model. It is a quantitative method used for predicting the price of a company's stock based on the theory that its present-day price is worth the sum of all of its future dividend payments when discounted back to their present value. While free cash flow measures a company's financial performance, it shows the cash that a company can produce after deducting the purchase of assets such as property, equipment, and other major investments for its operating cash flow. Second approach is relative valuations. It estimates the value of an asset by looking at the pricing of comparable assets relative to a common variable like earnings, cash flow, book value, or sales. So, in discounted cash flow valuations, the objective is to find the value of an asset, given its cash flow, growth, and risk characteristics. In relative valuations, the object is to value an asset based upon how similar assets are currently priced by the market. Next, I want to show some limitations of book value. That book value can be written down at management's discretion at any time. Businesses can hide both assets and liabilities off the balance sheet so that they are not reflected in accounting book value. In addition, it excludes other material factors that can affect the price of a company's shares. Shareholders are interested in knowing the market value of the company because after making payment to all other parties, the shareholders might be receiving payment in the end. They might be receiving the residual amount. Therefore, in this case, the shareholders will be considered as the residual claimants. So, book values are based on historical costs, while market values measure the current values of assets and liabilities. Market values generally will not match historical values. Intrinsic values is an estimate of the actual true value of a company, regardless of market value. Market value is the current value of a company as reflected by the company's stock price. Therefore, market value may be significantly higher or lower than the intrinsic value. If intrinsic value is more than market value, the stock is considered undervalued and a good investment. In the simplest of value strategy screen, if the ratio is above 1, the stock is believed to be undervalued and could represent a good deal. If the ratio is less than 1, the stock is thought to be overvalued. So, which model we choose for discounted cash flow valuation? We use the dividend discount model for firms which pay regular dividends which are close to the free cash flow to equity, and for firms where free cash flow to equity are difficult to estimate, for example, banks and financial service companies. Then, we use the free cash flow to equity model for firms which pay dividends which are significantly higher or lower than free cash flow to equity. And for firms where dividends are not available, for example, private companies. We also provide some formula for dividend discount model and constant growth dividend discount model. The constant growth dividend discount model, or DDM model, gives us the present value of an infinite stream of dividend growing at a constant rate. Other comparative valuation ratios, such as price to book ratio, is ratio of price per share divided by book value per share. Price to cash flow ratio is cash flow is less affected by accounting decisions that are earnings. Price to sales ratio, useful for startup firms that do not have earnings, and ratio of stock price to the annual sales per share. Comparable company analysis is the process of comparing companies based on similar metrics to determine the enterprise value. A company valuation ratio determines whether it is overvalued or undervalued. Let's have a quiz for this material. High price earning ratios tend to indicate that a company will experience A. Grow quickly, B. Grow at the same speed as the average company, C. Grow slowly, and D. Not grow. So, this is the end of this module. See you later.